let me add something critically important that could save you from an IRS audit, and it's about your balance sheet. Here's what most business owners don't realize. The IRS does not just look at your profit and loss statements. They examine your balance sheet, specifically your cash and bank account balances at the end of the year. And this is where people get themselves in serious trouble. If your bank statement shows $50,000 on December 31st, but you're trying to claim you paid out $80,000 in expenses that same day, the IRS will notice. They're not stupid. They have algorithms, and they have auditors, and they have your bank statement as well. If you are a cash basis taxpayer, which most businesses are, the rules are simple. You can only deduct expenses in the year you actually paid them, not when you incurred them, not when you received the invoice, and definitely not when you intended to pay them. That means if you're writing a check on December 31st, but it does not clear until 2nd January, it's technically a 2025 deduction. But you better make sure you can document that you mailed or delivered it by December 31st. If you initiated an ACH transfer on December 31st, that does not process until January 3rd, that's a 2026 deduction, not 2025. And if you charge something on your credit card on December 31st, yes, it is a 2025 deduction, even if you don't pay the bill until February. If you initiated ACH transfer on December 31st, that doesn't process until January 3rd, that's a 2026 deduction, not 2025. And if you charge something on your credit card on December 31st, that is indeed a 2025 deduction, even if you don't pay the credit card bill until February. If it feels like a cook in the book, don't do it. I see business owners try these moves and they're all red flags. The phantom payment. Recording expenses as paid in December when the money didn't actually leave your account until January, the IRS will compare your general ledger to your bank statement and catch this immediately. Asking a vendor to date an invoice December 30th when the work was actually done in January, that's fraud. Don't do it. Let's talk about the massive year-end dump. Suddenly claiming $50,000 in expenses on December 31st when your average monthly expenses were just $5,000, this screams audit risk. The balance sheet that doesn't balance, showing you paid out more money than you actually had in your bank account. This is the fastest way to trigger an examination letter from the IRS. What the IRS is actually checking when they audit a small business, here's what they are actually looking for. Bank reconciliation. Does your ending cash balance matches your bank statement? Did you suddenly have a massive expense in December that does not match your normal spending pattern? Round numbers. If all your expenses end in a 00 or 000, that's suspicious. Do your expenses make sense given your revenue and industry? Documentation. Can you provide every documentation with receipts, invoices, and payment records? How to do this right? If you want to legitimately maximize your 2025 deduction without raising any flags, here's the proper approach. Only accelerate what you can actually pay. Look at your actual cash position right now. If you had $20,000 in your business checking account, use credit card strategy. This is a legitimate way to accelerate your expenses. If you can charge $15,000 to your business credit card on December 31st for legitimate business expenses, that's a 2025 deductions, even though you won't pay the credit card bill till 2025 sometime. Why? Because for cash basis taxpayers, credit card charges are considered paid when you charge them, not when you pay off the credit card. Keep detailed records. Every payment you make today needs date of payment, method of payment, whether it's a check number or last 4 digits, ACH confirmations. Prove the payment actually cleared. Bank statement, credit card statement, business purpose, supporting document, invoices, receipts, contracts, etc. Make your balance sheet to reality on January 1st. Your balance sheet should reflect actual reality. If you pay out expenses on December 31st, your cash balance should be lower. The IRS will verify this. The honest truth about tax strategy. Here's what I tell every business owners I work with due to taxes. Tax strategy is about playing offense within the rules, not breaking the rules. There are hundreds of legitimate deductions and strategies available to small business owners. You don't need to cheat. You don't need to cook the books. You don't need to fabricate expenses. You just need to know the rules and use them smartly. The business owners who get audited and faces penalty aren't the ones who are aggressive with the tax law. They are the ones who cross the line into fiction. What to do if you actually made a mistake? If you've been reading this and thinking, oh no, I already recorded some expenses, don't panic, but do take some action. Correct your books now. It's better to fix it yourself than have the IRS find it. Talk to your CPA. They will advise you whether or not you need to make an amendment. Document everything properly going forward. Learn from the mistakes and don't repeat it. The bottom line, you have hours left in 2025. Use them wisely. Pay expenses that you can actually pay with money you actually have or with a credit card you actually have access to. Document everything meticulously. Make sure your balance sheet matches the reality. And remember, the goal isn't to maximize tax deduction at all costs. The goal is to minimize the tax legally while sleeping good at night. An extra $2,000 in deduction isn't worth the $20,000 penalty and an audit that disrupts your business for months. Be smart, be strategic, and be honest. Your business and your peace of mind will thank you later. This content is for educational purposes only and does not constitute legal, tax, or financial advice. Consult a qualified tax professional regarding your specific situations. D2 Tax does not assist with or condone any forms of tax fraud or misrepresentation.